With investment of local Chinese governments slowing down, it's no wonder that the country's landing scenario is a hot topic here at the Asian Investment Conference. Joining us now is Cheuk Wan, Head of Research Asia Pacific for Credit Suisse. China's growth outlook has been reduced to between 7 to 8%. Is that realistic?
I think a 7 to 8% economic growth rate would be a more sustainable and balanced growth track for China, especially when China is now undergoing an economic rebalancing to shift from an investment-led growth model to a consumption-driven economy. So I think a 7.5% GDP growth target is a more realistic growth track for China to target for the coming years.
What about the property sector? Are we heading for a collapse?
I don't think we are heading for a hard landing in the real estate sector, but I do expect further correction in Chinese property price and transaction volume. I think current property price level just detached from the affordability of the Chinese consumer, and the government has made it clear that the policy agenda is to bring property price back to a more reasonable level, and this is a normalization process, and the property tightening measures are going to stay for some more quarters, so the market should not have unrealistic expectation on reversal of the property tightening measures in China in the near future. But I think this is necessary policy action to bring to a more healthy dynamics in the real estate sector in China.
Let's move over to the banking sector. The credit to GDP ratio of 164% indicates that it is vulnerable to risks. How bad could things really get?
I think it's the massive credit expansion in China after the Lehman crisis do bring substantial financial risk to the system, and this will take long time for the governments to address the issue, including the capital replenishment for the Chinese bank, and I think the local government debt issue would remain a key focus of the market, but we have started to see some proactive action taken by the governments to impose more stringent control over local government borrowing, and this is going to be the ongoing policy focus in order to address the financial imbalance in the Chinese system.
So despite all of these issues, and finally, where do the risks and where do the opportunities lie for investors within the APAC region now?
In the Asian market, we still see the Asian region to stay relatively resilient in terms of growth prospect amidst the global uncertainties. Asia still deliver a pretty robust physical fundamentals for investor. So Asia Pacific remains the regions which deliver growth. So I think the market would continue to focus on the secular growth theme in Asia. We also like the domestic growth related sectors and companies. There are plenty of good quality Asian companies which leverage on domestic demand. And investors should focus on the domestic-driven sector, including domestic cyclical, the consumption-related sector. They're going to deliver better quality growth to investor, and they would also mitigate the risk of the uncertainty arising from the global debt problems.
Thanks, Stay tuned to AIC TV for more insights from thought leaders.